Welcome back, fellow investors. In this video, I wanted to discuss Journey Energy, an oil company from Alberta, Canada. So what is interesting about this company? Well, if you look at their November presentation, they are projecting to increase their production levels by about, 40, maybe even 45% in 2023. So that's curious. They're also making a projection of their following calculations based on the oil prices of $85 a barrel in 2023. We are currently trading at around 80. I believe Goldman Sachs is projecting average oil price of 130 in 2023. So we'll see how 23 goes, but I think that's an $85 a barrel is a pretty conservative number. So based on these numbers, the company, since the production numbers are increasing by almost 50%, we can expect an adjusted funds flow, which adjusted funds flow is something almost similar to free cash flow. So they expect adjusted funds flow of around 138, almost $150 million. Keep in mind, currently the total market value of the company is around $290 million, and they are projecting adjusted funds flow, the cash available to repay to the shareholders or repay debt or to make new investment, of almost 50% of the company's current market value. So that's great. At present, the company is being traded at 1/3 of the adjusted funds flow or free cash flow, or like dirty cash flow. So if you look at net debt, so these are the projected numbers for the end of 2022, which were given in November. The company expects to net debt to decrease. Well, apparently it looks like they are planning to generate more cash, and they did a bunch of investments in 2021, 22, investments, acquisitions, and accumulated a little bit of debt. And apparently they are looking to decrease this debt with the funds that they're going to generate in 2023. They are going to increase the weighted average number of shares. However, if you look at the notes to the financial statements, for the most part, this is going to relate to the purchase of the acquisition of a new of new production facilities. So they did that acquisition through mostly, let's say partially stock purchases. So they issued their own stocks and a little bit of debt and a little bit of, I believe, vendor financing. So, essentially, yes, the share number goes up, but the revenue and the actual production numbers go up even far more. So, the expected adjusted funds flow per share in 2023 is going to be, let's say, $2.4. And again, this is given conservative, conservatively estimated $85 average per barrel in 2023. Again, Goldman Sachs is talking about something in the range of $130 per barrel. So things look interesting. So you could kind of say that this company is trading at around P ratio based on the adjusted funds flow of 2 to forward-looking price to adjusted funds flow of 3 in 2022 and 2 in 2023. So things look quite interesting. What is an adjusted funds flow? Funds flow is calculated by taking cash from cash flow provided by operating activities from financial statements and adding or deducting changes in non-cash working capital, transaction costs, non-recurring other income, capitalized interest, decommissioning costs. So the biggest number in the biggest numbers for Journey Capital are decommissioning costs, which are which is a projected number, is a projected expense. However, this is essentially a non-cash item, so for now it is not affecting the financial statements of the company. Changes in non-cash working capital. Again, these numbers are just just remeasuring. It's a remeasurement of the working capital of the company. So adjusting funds flow demonstrates company's ability to generate funds necessary to pay debt and fund future growth through capital investment. So essentially, this is kind of it's a variant of a free cash flow. So let's do a quick discounted cash flow on valuation. So I'm going to use the free funds flow estimated by the company for 2023 of $2.38 per share. Then I'm going to extrapolate growth of then I'm going to assume three scenarios: normal case, best case, and worst case. In the normal case, I'm going to assume that the free funds growth is going to be of 0% for the next 5 years, 4% for the 5 years after that. I'm going to assume a discounted rate of 15 and terminal multiple of just 3. I'm going to stay very, very conservative. I'm going to assume that the market is going to keep to underappreciating this company. So in this scenario, based on the discounted cash flow model, the company should be worth around $14.27. Again, I'm assuming that for the next 5 years, the company is not going to grow. It's going to just repay its liabilities. In reality, if this scenario materializes, the company is going to repay all of its debt sometime in 2024, and it's not going to, and it's going to be forced to, if it's not going to do any other investments, it's going to be forced to start declaring dividends somewhere around 2024, or start doing some very heavy cash investing starting from 2024. This scenario it's my normal case, and it doesn't look and it looks extremely conservative or even negative. It is very likely, based on these numbers, that the company is going to grow. So in my base case, I'm still going to use the conservative numbers. I'm going to assume growth of cash flow growth of just 5% over the next 10 years. I'm going to still use a very conservative 15% discount rate, very conservative for a company located in a developed market. I'm going to use a terminal multiple of 3, which is exceptionally low. And in this case, the company is worth $17. Okay, in my third scenario, the worst case, we are going to experience a prolonged recession. And in this prolonged recession, we are going to incur a 25% decline in the cash flow generated by the company over the next 5 years. So the cash flow generated by the company is going to keep declining over the next 5 years. And then we're going to experience growth of just 4%. I'm still going to use a terminal multiple of 3 because using a terminal multiple lower than 3 is just insane. I don't think I don't believe that happened even in the recession in 1929-2030. So I'm going to use discount rate of 15. So then the company is worth then just $5.43, while currently it's being traded at around 4.8, $5. So it's still being traded lower than this number. So if we add up all of these scenarios, assign to them equal level of probability, then our net present current value of the company should be $12.25, while the real current value of the company is just $2.80. So it is undervalued by about 2.6 times. So there is, well, based on this model, there is a lot of opportunity to make money in the company. If you play around with these numbers and kind of assume what kind of return on investment you can expect, if you change the discount rate to 50%, we get the current market value of about $4.8. So buying at current price of $4.8, you can expect a long-term return on your investment of about 50%. Well, Warren Buffett's long-term return on investment was about 21%. So this could be a very good buying opportunity. So now I'll switch to the technical chart to see what could be an interesting entry point. On the technical chart, we can see a triangle formation that started forming in February 2022, and we are currently trading right near the support trend line of the triangle formation. So we are already trading at the presently we are trading at price to cash flow generated by the company of around 3. It is likely that when the company increases its production volumes, we're going to be trading at price to cash flow of around 2 at current price. So I would kind of, if the multiples stay the same, we have to at least appreciate by $2.50, moving to around $7.50, I would assume. So in my opinion, it is very likely that this support level is either to hold or to transform to something of a support of around here in the range of $4.3, well, or $4.50. Otherwise, there is a very strong support, should be a strong support at around $3. Well, if the price ever gets over there to this level, this is a no-brainer. You should just sell everything and buy the stock with all the money you can. So in my opinion, this is very positive formation, and this is a very good entry point with a very low risk. So if you enjoyed this presentation, like my video, subscribe. I'll keep posting more interesting information. Cheers, goodbye.